Discounting. Concept and time value of money. Discounting reflects the principle that money today is worth more than the same amount in the future because of its earning potential. The time value of money underpins all capital investment decisions, as future cash flows must be adjusted to present values to ensure comparability. Discounting involves applying a rate that reflects both the cost of capital and the risk associated with the investment. The higher the risk or required return, the greater the discount applied. This principle ensures rational investment evaluation, preventing overvaluation of distant or uncertain inflows. By converting future amounts into present terms, discounting allows management to compare alternative projects on a consistent economic basis, supporting capital allocation that maximizes long-term shareholder value. Mathematical basis and discount factors. The present value, PV, of a future cash flow equals its future value, FV, divided by open parenthesis 1 plus R close parenthesis to the power of n, where R is the discount rate, and n the number of periods. Discount tables or financial calculators simplify computation by providing discount factors for varying time horizons. These factors decline over time, reflecting diminishing present value. The choice of discount rate is critical. It may represent the firm's weighted average cost of capital, WACC, or an adjusted rate for project-specific risk. Consistency between nominal and real rates is essential when inflation is relevant. Discounting ensures that cash flows occurring at different times are evaluated on the same financial scale, facilitating meaningful comparison between projects with differing durations or cash flow patterns. Comparing annuities and uneven cash flows. Many investments generate regular cash flows resembling annuities. The present value of an annuity is derived from the sum of discounted periodic payments, calculated using annuity factors. This allows comparison of projects with different lifespans or cash flow structures. For instance, the PV of a 5-year annuity can be benchmarked against a lump sum alternative using equivalent discount rates. When cash flows are uneven, each is discounted individually to present value before summation. Comparing annuities aids in evaluating leasing, loan repayment, and recurring revenue projects. It also highlights the impact of timing. Earlier inflows contribute more to NPV than later ones, reinforcing the strategic value of accelerating cash generation. Profitability index and capital rationing. Under conditions of limited capital, discounting enables computation of the profitability index, PI, which measures the ratio of the present value of future inflows to the initial investment cost. A PI greater than 1 indicates value creation. Ranking projects by PI ensures optimal utilization of scarce capital resources by selecting combinations that maximize total NPV within budget constraints. The PI thus supports efficient capital rationing and strategic prioritization. However, while PI provides a useful relative measure, it must be interpreted alongside NPV to avoid bias towards smaller projects. Together, these metrics ensure rational investment decisions that balance financial efficiency with organizational goals. Role of discounting in risk and sensitivity analysis. Discounting not only measures time value but also incorporates risk. Adjusted discount rates can reflect varying risk levels between projects, industries, or geographies. Scenario and sensitivity analyses examine how changes in discount rates or cash flow estimates influence project outcomes, identifying thresholds for viability. Monte Carlo simulations may further model probabilistic outcomes. By embedding risk within the discounting framework, firms create robust appraisals that withstand uncertainty. This dynamic approach ensures that capital allocation remains resilient under changing market conditions, reinforcing the link between financial modeling and strategic decision-making. Strategic and practical implications. Discounting transforms investment appraisal from accounting evaluation to strategic analysis. It quantifies opportunity cost, encourages long-term thinking, and supports transparent communication of value to stakeholders. However, misuse, such as applying inconsistent discount rates or ignoring non-financial benefits, can distort outcomes. Managers must combine technical precision with strategic judgment, interpreting discounted results in light of market realities and organizational priorities. When integrated with non-financial metrics, discounting becomes a cornerstone of value-based management, enabling firms to align financial evaluation with sustainable growth and risk-adjusted performance.